Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis, and Merry Christmas.
Merry Christmas. How are you?
Well, give me that one again.
Merry Christmas. How are you doing?
I'm good. I'm good. Thank you.
Or as Frosty would say, Happy birthday.
I like it. You know, you don't want me to go into it, neither do the listeners, but
right.
Old Frosty was a snowman, and to the snow he said no man. And there's a whole rap that goes with that we won't do. But hey, no, Merry Christmas.
That you're not going to do?
I'm the one that knows it. There's only one of us here that can do it, and it would have to be me. And they don't want to hear me.
That's all right. There you go.
Sue's not here to help.
No, okay.
You know, with the actual melodic voice, the angelic sounds of Sue singing, not here to help, so it would be bad. But hey, no, seriously, Merry Christmas. I hope it's a holly jolly one.
Yeah.
And
we're one way or the other, we're heading right into it. So, yeah.
This is it as we record this on December the 23rd, 2025, the last Taking Stock of 2025.
There you go.
The final episode for this calendar year.
It's amazing. I mean, the things that we've talked about this year, and it all seems like yesterday, but, even like tariffs and all that stuff was back in February, and it was 10 months ago.
Well, you know what, and it all started with, as we began the year 2025, we were looking at, the inauguration of a new president, Donald Trump, and his second term, and now that has probably fueled a lot of the discussion, fueled a lot of whatever has happened in the U.S. economy and the global economy probably. My arms are going wide.
Yeah.
People can't see that, but anyway. So it's been a year, hasn't it?
It's been interesting, but it's been a very, very good year.
Well, the reports say that exactly. I'm glad you're doing well. I'm happy to say I'm doing well. And as we launch into this Taking Stock number 64, as I said, the final episode of 2025, let's just jump right into. You shared some information with me. I got a text message. I love that. I get those text messages from Art in the past 2 weeks. Well, this one just came today.
Yeah, timely.
Very timely. Yes. Bright, cheery Christmas news. Yeah. And the first thing we're going to talk about, Art, is the economic growth rate.
Yeah.
Some really good numbers.
Yeah, the gross domestic product number was this morning, and it was the update for third quarter of 2025. Yeah. And, they were looking for like a 3-point-something number, and it actually ended up being 4.3, which is a great number.
Yeah.
And,
almost a full point higher because they were looking at the 3.5.
Yeah.
And it was 4.3.
Yeah, and even if they're off by a little bit, 4.3, that works for me quite well. I mean, we've gone through how many years where we kind of get into the discussion that the R word, that we're going to run into a recession. Well, here we are finishing up our third or fourth year, and not only are we not in a recession, we're looking at an economy that's growing by over 4% a year, and that's been helped. As we always continue to talk about, it's the consumer. They're still in it to win it. The consumer spending was up, what did we say, like 3.5%, up from 2.5% year over year. So not only are they not slowing down, they're picking up the pace, right? So that's kind of interesting.
The headline on it was very interesting. The wealthier Americans are upping their spending. It's interesting that they put that the wealthier Americans are upping their spending. I guess that allows for people who, might not be as well off, maybe aren't helping to get that number up as high as the wealthier.
But the interesting thing is that here over the last couple 3 decades or whatever, the ability for people to participate in the markets in some way has expanded greatly. the things you can do, simple IRAs and Roth IRAs and 401ks, and the amount that you can put into them if you want to. So let's just say we're up 15 to 17% this year, right? So if you're looking at 401ks and things like that, and housing values and things like that, that's again, there is a part of the economy that does not get to share in that, but the amount of people who could or has the potential to share in that is expanded greatly. So if you're sitting here at the end of the year and you're starting to look at your spending and things like that, and your house has gone up, whatever that number is, 5 to 10%, and your investments have gone up 15 to 20%. Yeah, you're much more comfortable spending than you would be if it was, let's say the beginning of the year where we were down 20% at one point. Yeah. So
well, we are, believe it or not, taking stock is literally just at the halfway point into our third year of taking stock. And I bring that up because here we are. So we're pretty much right at the halfway point into the third year. And it's actually been a while, Art, since you and I have talked about how easy it is and how important it is for everybody to, participate. Touching on that a little bit with, we highlighted and focused especially on the young. If you want to plan your future, your economic future, and for it to be a good, healthy opportunity for you to retire down the road and have what you need along the way, participate in the market. Yeah. And you just brought up several different ways that opportunity to participate, as you said, has expanded greatly with the IRAs, the 401ks, and probably right now, Christmas time is a good time to bring that back up. Maybe some people at Christmas will get a few gifts, grandma and grandpa and aunts and uncles might give them a check.
Right.
Deposit that in an investment participation plan.
At least part of it.
Right?
Yeah, I'm a big fan of, if you take some money and you've got, okay, this is my very long-term retirement, this goes into that pot, and this amount of money goes into the pot for not as long-term, but more intermediate-term goals.
Sure.
Like buy a house, buy a car, something like that. And then you got your fund money. So then take a third portion of it.
I love that.
That's your fun money, right?
Oh man, yeah.
So at least you're having a little bit of fun. You're kind of planning for the things that are coming down the pike, but then you're also taking care of retirement. So you know what? If you do that most of your life, you usually end up in pretty good shape. So
exactly. Well, I just thought that you just reminded me as you were talking about it, and the fact that we're 2.5 years in to taking stock, good. We haven't touched on that in a while. I just thought, hey, it's great to remind people that there is a way. Don't feel like that headline, the wealthier are spending. You don't have to be the wealthier now, but you can help yourself get over toward a little bit better wealth and health for your family's economy. Yeah. Because there's so many opportunities to get in. So again, that came out of the discussion of the consumer spending is up. What was the other thing? For the U.S. economy, exports.
Yeah.
Was the report. The exports are up. I mean,
substantially.
That's the word. That's not even funny. I mean, It is substantial. They said up 8.8% from minus 1.8%.
Yeah, so you basically have over a 10% swing.
That's huge.
That really is. And we get gross domestic product. If you're 70% of it's the consumer. Well, guess what? The consumer is clearly still spending and is actually spending a little bit more.
Right.
And then you look at the import-export number. Well, that's 6 or 7% of gross domestic product. Well, that number's had a 10% swing here this year. So then the rest of it is government spending and investments. But it's that's two components that a 1% difference in consumer spending is a very, very big number. Okay, because when you're talking trillions of dollars, 1% on $1 trillion, that's a big number. Yeah, so it's it's interesting that
there's that trillion again, Art.
Yeah, well, it's we're still waiting to get our first trillionaire. We've talked about that before, but it's interesting to me that and I've been talking to clients here a lot lately about it's been a good year and here's what we're looking for in 2026 and things, and the one comment I make to them is we've had 2.5 good years in a row here. And if I look at the economic numbers and I look at the earnings numbers and I look at interest rates, I don't, at this moment in time, I don't see any reason why next year can't be a good year. Could we have a normal 8 to 10% year next year? Most certainly. I mean, and the thing I kind of said over and over again is we're not staring down the barrel of a recession. Yeah. There's nothing in the numbers right now that say, "Oh, we got some trouble coming next year." Now that doesn't mean someone can't do something stupid next year.
There's no economic gun pointed at our head right now.
Again, and here we are again. It's like it's not. There's just there's some negative rhetoric, but there's not negative
which
numbers,
there's always going to be, right?
Yeah, I mean, payrolls have slowed down. But also last week, we got a much better than expected payroll number. And it was a positive payroll number. Okay?
Well, now, wait a minute. I didn't get that text.
You didn't get that text? I must have been off that day. But, it's you just sit there and go, they were looking for some very low payroll number. It ended up being much higher than what they were expecting. It wasn't 200,000, so it's lower than it has been in prior months, but it still was better than expected, and it was a positive number. So again, for me, as long as that number stays positive and we don't get into some major start where employees start dropping off, I take that as a positive.
You had to be very happy and very positive when President Donald Trump stood up and addressed the nation last week, and he had listened to you.
Yeah, okay.
And I watched Art. You can kid all you want. I watched that address, and I said clearly, Art gave him the information because it did. For listeners, some had to have watched and paid attention to what we all heard about the economy and what's going on. And I watched that and said, well, duh.
Well,
what the heck has Art been telling us on taking stock every couple of weeks for, really, in all honesty, certainly for all of these 11 months into 2025. Mm-hmm. And I think it's very important for whoever the leaders are in the world, and certainly our president, the leader of the United States, to stand up and say, these are the facts of what's happening. Yeah. But regardless of the rhetoric that we get.
There's a lot. We're very clear about the kind of information that comes over the internet and things like that. And this may be a surprise to you, but some of the stuff that comes over social media isn't always factual. I'll use the word factual, right? So.
Well, that's shocking information. That's brand new. I thought that everything I saw. Oh no, never mind.
So you'll find this also very interesting, and of course I'm kidding, but back in the 80s, Donald Trump actually wrote a book. Do you remember the name of the book?
Oh yeah, you caught me off guard. No, I know. Except what is it?
It's The Art of the Deal.
The Art of the Deal.
That's right.
I knew this. I was like, we've talked about it.
You don't think that's coincidence, do you?
No, I don't. However, you and I sitting here saying it's not a coincidence and believing and trusting a little bit in the art of the deal and what that means to the man who's in the position of President of the United States, we're in the minority apparently of people that believe that he knows what the heck he's doing and that the art of his deal is in fact a positive outcome. This isn't. It's about put America first, right?
Well, but it's supposed to be.
Well, you know what? And that's the thing. It's put America first again. But America first. And I'm sorry, Chuck, on a soapbox for a second here. America first. Who's Who's the protector of the freedoms of the entire world? America.
Right.
Right? The United States of America. It's not China. It's not Russia. It sure as heck isn't Great Britain, and it's not Canada. Name all, whatever countries, it's not the conglomerate of the entire Middle East. Where the people, that's why there's an immigration issue. People want to come to the United States still. So the guy that's the Art of the Deal author is the president of this nation, and he's making deals and bringing peace where? Around the globe.
But you have to remember that, and it's going to be very interesting to me to look at the next 2 or 3 years. When we ran headlong into a brick wall in 2020 with the pandemic,
right?
Everything was firing on all cylinders at that time. I mean, interest rates were great, unemployment, inflation, all those numbers. The gross domestic product was running at 3-point-something%. And now here we are running at 4.3, technically, theoretically. So, according to
what happened? And that was the end of the first term of President Trump, who came in with kind of the same, his own same rhetoric of I'm going to do this, we're going to put America first, make America great again. Everybody's heard it, knows it, MAGA, yada yada yada. And no, I'm not actually campaigning for. As much as it sounds like, I'm just looking at the facts. I watched that address to the nation, and I didn't see any fact checkers come back and say, well, that was a lie, that was a lie, that was a lie. That didn't happen. He addressed the nation, said, here's what's going on right now. So at the end of that, where we ran into the wall, that was the end of his first term. In the interim, when we ran into that wall, and then not only was it a wall, but apparently it was a wall that threw us backwards and downward for the next 4 years.
Yeah, I mean, again, that's several hours on a show, but it's. I still go back to, and how I feel about our current Fed chairman. We dealt with what we had to deal with. Whether we should have dealt with it this way, should not have dealt with it that way. Okay, I tend to give him a little bit of grace.
Well, the biggest problem there is Jerome Powell hasn't taken your phone calls. That's
He again. The fact is we threw $6 or $7 trillion into the economy during that time frame. You pump that much money into the economy, you're going to have to deal with inflation somewhere, and we did a very poor job of circumventing that inflation that was coming down the pike, right? And that we've talked about this numerous times. It caused damage, greater damage to our economy than really the pandemic caused. All of a sudden, we're still doing it. Interesting enough, by the way, we're sitting here today and gas is at $2.12 a gallon. Locally, right? So, one, I'm like, well, check this out. But, number two, we're still dealing with rising meat costs and things like that. That still is impacting us, 5 years later, right? So, but even worse, and where I was really trying to get to, is our cost of servicing our national debt is way higher than it was 5 years ago, right? And not only is our cost of servicing it's also went from 20-something trillion dollars to $34 trillion.
So here's the question, because and it's understandable as you're making the point about our cost of servicing the debt went way higher than it was 5 years ago. My question to you is, do we know, are we seeing a trend? Is, Art Jarvis trends. So is there a trend developing where that cost of servicing the debt is going to start to lower now?
Well, yeah. So and that's actually
that's a yes.
That's a great yes. Okay. Well, because we've had 3 rate cuts here in the last few months.
Right.
Okay, so theoretically, that should hopefully start to get the rates to start. But the rates haven't really moved that much. We were maybe at 4.5, and right now we're at 4.17, 4.2, or something like that on the 10-year Treasury. So we've had 3/4 point rate cuts. We're still sitting at like 4.2. So, that's where the rates are. So every time the Fed comes out and they put out their new Treasury bonds or Treasury notes or Treasury bills to service our debt, that 10-year is still at 4.2%. So when they float those out there, there's people are going to, when they buy the bonds or the notes, they're still going to pay 4.2 or whatever they're paying at that level. So, and honestly, that's a good question. But the one thing I wanted to point out is that kind of segues into something else I want to point out. We have an economy that just got revised for third quarter that we're up 4.3%. We've been working very hard over the last few years to deal with inflation, beat inflation down, get the horse back into the barn or at least into the corral, and we've been lowering rates. And we've talked about this before. They talked about, we want a quarter point cut, and I've said it's like I don't know why we need a quarter point cut. We beat back inflation. All you're doing by lowering rates is actually kind of pushing down on the accelerator a little harder.
Right.
So what concerns me about an economy that's maybe growing at 4% plus, what's inflation going to look like down the road? Are we going to have to start dealing with inflation again? Because, I didn't think we needed the first rate cut. I definitely didn't think we needed the second rate cut. And I for sure didn't think we needed the third rate cut. But everybody wants a rate cut, right? So that's the interesting thing about right now is you got an economy that's growing at 4.3%. Like that kind of, in my opinion, that kills the possibility of doing another rate cut.
What's the number you like for the Treasury rate? Which you said, it's at 4 point what?
Yeah, if you're looking at the 10-year, just call it 4.2 right now. It's right around there.
And what would you like it? What do you think is maybe an ideal spot?
I'm okay with. I have no problem with it being at 4%. Okay. So if we're at 4.2, theoretically we can get mortgage rates down into the low 6s, upper 5s. That's a very reasonable number. That's way better than 7.5 or 8.
But it's not 3.
It's not 3, but you know what? When I bought my first house, we paid 8.5%.
Yeah.
Right.
Well, you and I both know that, right?
And then we refinance.
That was 9.25.
Yeah, and the last time I refinanced was 3%.
Right.
So I've got this 3% number floating around in my head, but guess what? Back in 1980, my parents had a 16% mortgage.
I was going to say, you mentioned 8, and I said my first one was 9.25, and of course, you can buy down some points, so we were really lower than that because of the buy down. But what I was going to say is what you just touched on. If you go back and late middle 70s, 76, 77, 78. My parents, I think they had one like 13. And you're talking about your parents in the early 80s was 16.
And again, they didn't share that information with me, but let's say it wasn't.
Well, and it wasn't. But you mean, that generation, not specifically your mom and dad, nor do I mean specifically my mom and dad, but they were seeing 13% rates. They were seeing 16% rates. The families that were getting mortgages at the time, that was ugly.
Yeah.
But anyway, so I get what you're saying. If it's at 4, if the Fed is at 4, and that means that mortgage rates might be around 6, and you say that's not bad.
And so from that standpoint, it's a doable number. But also, if I'm a business and I'm looking at my weighted average cost of capital on like any projects I want to do or anything like that, if my weighted average cost of capital is 4%. And I can make 8 to 10% on the project or whatever. Sure, that's great. Compared to I can make 8 to 10%, but interest rates are at 7 or 8%. All of a sudden that deals. So that's good for the economy. So again, that piles on top of the fact that we're already in an economy that's growing 4.3%. And now we're talking about having a nice spread, and so it's going to, are there going to be even more projects, and is that going to further heat up the economy? I'm not trying to be Doogie Downer here, but at the same time, it has concerned me all year that we've been lowering interest rates. So
the last rate reduction was the October.
No, we just did one in December.
Well, I was going to say I missed the December news. I thought what I was sitting here thinking, Art, was that actually the December 1, Powell came out and said we're not going to do anything.
Yeah, I think.
But they did lower it quarter.
He can, yeah, so we lowered in September quarter, we lowered in October quarter, and we lowered in December. But you're right, he did come out and say, we're probably going to take a breather and not do any more rate cuts.
That's what it was.
That's what he said.
Yeah.
But, I'm kind of sitting here, I'm kind of, well, you already did 3 of them. So, but, again, I think a lot of what we're talking about here bodes very well for next year. Okay, but we have to have someone in there that is paying attention to these things and making sure that we don't get ourselves in trouble. With
Not until March.
Stuff. Well, yeah. I honestly try and be a little bit gracious and try and be kind, but it's just that whole thing was just severely damaging to our economy and to the way things are. But
your graciousness is appreciated.
I'm not sure. We'll see.
Well, I mean, here on the show at least, it's not barking. It's very clear where your position on the current Fed chairman, but it's very clear on the position of the current Fed chairman in the eyes of our current president as well.
Yeah.
So that's why I say not until March. But you know what? So we've been talking for about 25 minutes now during this episode, and it's been very positive. It's been very joyous and cheerful news at this Christmas season. And I don't, as we enter the final 5 minutes of this episode, Art, I really want to take a minute because it is Christmas and it's the end of it's the end of the year, the end of the calendar year. So what are the kinds of things in the world of investing, in the world of our economics, even our national economy?
Sure.
That are important at the end of the year? What are some things that come to mind for you?
Yeah, if I'm looking at the top 3, that's a good question. I mean, the top 3 is, number 1 for taxable portfolios. I spent a good amount of time trying to offset any capital gains that we took during the year. So try to lessen or nullify any kinds of taxable consequences for 2025. So make when you start doing your taxes at the beginning of the year, make things a little easier. So we start to trying to do some of that tax harvesting or whatever you want to call it. The other thing is required minimum distributions.
Right.
If
we touched on that a little bit on the last. But
if you're 73 or you have an inherited IRA, depending on when the person passed away. You may be required to take distributions during the year, because the government somewhere along the line wants to get their money.
If you haven't already been out front of that and done it, then don't forget it in the next week.
Right. Yeah, some people obviously do it. Some people do it like first thing in the year. It's okay, let's just get it over with and be done with it. Other people wait till the very last minute, which I'm kind of a fan of, because then any kind of stuff you kind of grow tax deferred.
That's our typical strategy for Sue and I is we wait like October, November.
Sure.
As long as you can.
Yeah, just don't cut it too close.
Because I mean the bottom line is it's in there, it's still growing.
Yeah.
So keep it as long as you can, and then when you have to take that money out.
Precisely. You got it. Yeah. I mean, in the long run, you can have something grow tax deferred.
Well, minimize the tax.
Yep.
That's 1. 2, you said don't forget about the required minimum distribution, and then 3 is
your charitable giving. So there's a lot of things. So there's out there a lot of people now are doing what's called QCDs, which is qualified contribution distributions. Yeah, qualified charitable distributions. I always mess that up. So and that's an opportunity where then again that if you have to take distributions out of your IRA or something like that, you can actually do those directly to a charitable organization. So
that all lends itself to the minimizing the taxable.
100%. Yeah. So that's if you look at my all of December and a big chunk of November, I spend a lot of time. Just making sure we have all those things taken care of. Charitable distributions are kind of a personal thing, right? Required minimum distributions are a thing that has to be done, and you need to make sure that gets taken care of, because if you don't do it, the government can get very ugly in regards to that. And then the other thing with just, it's important to, you can have great returns, but if I mess all the returns up by taking a whole bunch of charitable gains and don't try to offset them, you actually make your overall gains, your real gains, drop a little bit.
Right.
We don't want that to happen. Now,
you're paying Uncle Sam.
Yeah, part of the problem is that again, going into 2020, and we're starting to kind of have that problem now, is the vast majority of things in the portfolios are in a profit position. So you go and look, okay, I need to offset $1,000 worth of long-term capital gains. Well, I got a problem. There's nothing in the portfolio to offset it with, right? So you're just going to have to eat $1,000 in capital gains, right? So, but yeah, that's a great question, and really those are the three. That's the three big things in November and December.
Excellent. Well, I think a lot of positive news to close out this 2025. I mean, it was kind of fun today.
Yeah.
Yeah.
It's a nice review. We've had a good 2025 will be a year we look back and go, that was a good year.
And speaking of reviews, as we close out this episode 64, we are going to start 2026 on, we're going to record the next Taking Stock. Episode number 65 will be recorded on Tuesday, January the 13th. Okay. And you're going to have the time of your life because Chuck is going to confront you.
Yeah.
I'm just being mean. But anyway, what we're going to do is we're going to do another review on that first episode of 2026 calendar year. We're going to take a look back at what Art's projections were for 2025. We should have all the numbers in by the 13th, and it'll be fun to look back and see. We're not going to get into a big discussion because we're at this closing minute.
Right.
But you did mention, and I'll let you say it, the S&P at noon today was at...
As we speak at this moment,
is
at exactly 6,900 and 0.62. But, so I think if...
8 days left in the year.
Well, 4.5 trading days.
Well, there you go.
Yeah, so unless somebody does something really stupid next week,
it's right there.
I'm feeling pretty good about that prediction.
Pretty good. Well, I'm feeling pretty good about a fine year of taking stock in 2025 and feeling really good about this Christmas holiday that we're going to celebrate. So Art, once again, Merry Christmas to you and all of the Jarvis family and all of the Jarvis Global Investment family, which I think is pretty much the same family.
Yeah, pretty much. We keep things close.
But listen, Merry Christmas to you guys, and get the new year off to a good, safe, happy, and healthy start. Thank you so much.
Merry Christmas to you and yours, and also Merry Christmas to the listeners, and I'm looking forward to a fantastic 2026. So.
Better than 2025, and again, as you just said, Merry Christmas to all of you listening in. Thank you so much for your support as you listen in on Taking Stock bi-weekly. Thanks for listening. Merry Christmas to you and yours. Until 2026, this is Taking Stock. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.